I guess before we really start this podcast, one thing I really want to put it out there as a disclaimer is that even though like I've spent a lot of time using DeFi apps, and same goes for Braden as well, and I think we have formed this intuition around different primitives, but we would be the first person to kind of admit that we don't fully understand how some of the system works behind the scenes. Like we pretend that we understand stuff, but it's just like it's too late to even ask stupid questions, right? So I think we have just gathered you both here just to ask all of our dumb noob questions around some of the stuff that's happening in DeFi. And yeah, that's why you guys are here.
Sure.
Yeah, awesome. Happy to be here.
Bitcoin's price is gonna go up in next few months.
If you're winning, someone else is losing.
I would love to eat some of your food sometime. You seem like a great chef.
There's no free lunch, really.
Whatever you're trading for, that's exactly what you're trading for at that moment. Just
And try not to lose a lot of money.
It's not as simple as that.
Market makers and LP providers are my enemies.
I have more questions about that.
You're based in the US. No, you can't. You can't.
People would be wondering, like, what does that actually mean?
Not gonna lie, I did use ChatGPT last week to try to understand everything. I still am trying, but I think, yeah, let's Prince, take it away so that I can actually learn something.
Over the past few months, there has been a lot of momentum on the DeFi front within the ZK Sync ecosystem as well, right? So for starters, if you're not aware, ZK Sync's first governance proposal was posted on the ZK Nation forum that introduced ZK Sync Ignite, which is kind of like a DeFi incentive program, which will turn ZK Sync Era into a liquidity hub for all the elastic chains out there. So that's like a huge news, right? And then there is the RFX liquidity generation event that happened on October 14th. So phase 1 of RFX Interstellar Voyage is live. And then West, on the other hand, launched their public mainnet back in July. So clearly it's been like a crazy few months here, right? So Justin, Karan, for all the listeners, if you can break down what RFX is and what West is, like what are you guys have been working on?
We went live a couple of weeks ago. It's been a long time coming, to be honest. Like we've been building for more than a year. I think we did a closed testnet back in May on ZK Sync Sepolia. But quite happy that we're finally able to go live and the product's out in the hands of the community. And I mean, I guess a little bit like about what RFX is. I think like the elevator pitch per se is that it's a derivatives protocol that allows LPs to optimize their risk and automate their yield, and then it allows traders to streamline their execution and create their own trading pairs. I would say, in short, that's what we try to do. Broadly, though, like the goal is to try and do like 3 very specific things, which is minimize liquidity fragmentation, improve capital efficiency for traders and LPs, and increase APRs for LPs. And I know like there's a few maybe like buzzwords there for a lot of people that maybe aren't familiar with like Perps or DeFi, and I can maybe explain a bit more about what these mean. Like I'd say like capital efficiency, it's used a lot. Like, I'm sure Justin also knows, like in the perp space specifically, the goal is to be as capital efficient as possible. But most people will be wondering like, what does that actually mean, right? And I think at its core, what it does is it measures the productivity of your assets, right? And in the context of like perps or dexes, it kind of inherently like means different things when you're an LP and when you're a trader. Like from the perspective of an LP, I would say like capital efficiency is probably best measured by like the ROI or like the APR. So like every dollar of sort of returns that you get for every dollar of liquidity that you're investing, right? And so it's linked to the volumes that come in and then also the utilization of your capital. But then for a trader, it's very different. For a trader, it's kind of how much exposure can a trader get to a market for the cheapest cost or the cheapest unit of like capital that he invests, right? And if you like look at that, they're actually like polar opposites, right? Like LPs would want the cost to go higher and traders would want the cost to be lower. And like you kind of have to try to find that balance, especially if you're like an LP based DEX, which both like RFX and Vest are, right? So you want to try and find that balance. And I'd say like, so the way we try to do that in RFX, like our thesis is like long-term liquidity is king. And what we want to optimize for is the LP experience. And then we believe if you have deep liquidity, if you can offer deep liquidity and a conducive like trading environment, then trading volume will follow. So that's what we try to do, and we try to do that by allowing, giving LPs like maximum flexibility on which pool they want exposure to, If you're a more advanced LP, then you can like configure vaults to sort of programmatically deploy your liquidity, so you don't have to like monitor or rebalance your liquidity constantly. And if you're like a retail user, then we have something called like the shared liquidity vault that does that now. It's going to go live in like a day or two, where it'll open up for deposits, but it sort of automatically allocates liquidity between markets where liquidity will be most productive. So where there's more volumes, there's more APRs, more fees, right? And so that's kind of what we're trying to do. And then like as I mentioned in like the elevator pitch, we have permissionless market creation, which I think for traders can be quite exciting, because you can come in, you can create your own trading pair. If the risk profile of that trading pair is sort of passes the thresholds that we've set, then you'll be able to pull from liquidity that's already on the DEX. And so that means you can execute things like pair trades. I don't know how much you guys know about pair trades, or if you've heard about them. I know Justin would definitely know about them, but whether either of you do. But it's kind of like a small niche right now in crypto. But I don't know if you saw, like even in equities, they announced like an application for like battle shares, right? So it's pair trading is catching on, where it's basically you can speculate on two correlated assets. So you go long one asset, short another asset, and try and either hedge or try to double down and increase the returns. So like the ETH Sol pair trade is quite common on CT, or the ETH BTC is like the OG pair trade, right? So on RFX you'll be able to like create combinations of different pairs, like you can do BNB Sol, ARB Sol, so you can like trade narratives, you could trade fundamentals, or you could like create new pairs to like hedge to arbitrage like funding rates. So there's a bunch of cool things that will allow traders to do, and like I said, like the goal is to just try and give them the tools to sort of optimize their execution, and that's how we want to grow.
When I was starting trading stuff, like that was one of my first thoughts, and I was like, if only I could trade like both these assets, because I really know that ETH is gonna like go down, but like the other asset's gonna go up. So like, how do we do that? So it's good to know that this is coming. So I'll definitely try, and try not to lose a lot of money.
And it's called a pair trade or bear trade?
PAIR, like a pair.
Oh, okay, a pair trade. Oh, interesting. All right, I've more questions about that, but I guess before we dive further into that, Justin, if you want to do the same and then do a little overview of Best.
I think for the most part, we relatively align with RFX's approach in terms of maximizing capital efficiency. But to kind of give some context on how we're different, I think it's good to explain the story of where we came from. Right, so Vest started off as a quantitative crypto research firm and trading firm. So we were delta neutral market makers. We did a bit of protocol MEV, mostly funding rate arbitrage, and we were trading on exchanges like Drift, Mango, 01, DYDX, Perpetual Protocol, NFT Perp, like all different kinds of exchanges. And this was back in 2021 and 2022. And at some point, guys, like I think I listed 8 exchanges, and 7 out of 8 of them blew up and went insolvent, right? And I think all of us are in this space because we witnessed the potential for blockchain and crypto to solve a lot of the problems that exist in traditional finance. And kind of seeing these blowups happen, I think really punches us all into the gut a little with, so much potential in the space, but like how can so many blowups happen? And from our perspective, we see it more as a spectrum between capital efficiency and risk management. So on one side of the spectrum, you have things like that are generally low capital efficient. So things like Uniswap, where assets are backed 1-to-1, but the risk of insolvency is very low. And now on the other side of the spectrum, you have things like virtual automated market makers, where there's very high capital efficiency in terms of, let's say we have $1 in TVL, but we can allow $100 worth of leverage, so 100x leverage, but you have a high risk of blowup, right? And generally along exchanges and crypto, they somewhere align in the middle. And we think that the capital efficiency problem mostly relies on a balance of somewhere lying into the spectrum. And it's a balance of how much risk management you can provide onto your exchange without blowing up your exchange. So fundamentally what we do is we ask ourselves the question, okay, what is the most capital efficient we can go without causing this risk of blow up for LPs or counterparties, and without needing to, and this is one thing I think that is very good to touch upon, about the difference between a product like this versus a central limit order book or like a club or a market maker based exchange is that in this case, the risk of the protocol is actually done with a singular coherent framework, whereas in a club, you're effectively outsourcing and giving third parties control of the risk mitigation of your exchange. Because pricing on a club is purely determined by market makers, and you're inherently relying on their risk profiles for ensuring liquidity on your exchange. And I think on this podcast, we'll talk through many examples that has actually happened on some of the top big dexes where this inherent reliance on market makers to come in and ensure liquidity and risk mitigation ultimately fails. So that's fundamentally, from first ground principles, what VEST does. And I think the ramifications and the outcomes of, starting from first principles shows a lot. And there's a lot more to tackle in, but for now we can kind of start at that baseline, and I can kind of reveal the great trade execution you get from tackling problems like this. In terms of, we're talking very, very great trade execution, 100K trade on a relatively long tail asset with pretty low slippage depending on the volatility of the asset. But we have plenty of time to talk about that.
Yeah, for sure. And I think this is we can go through this good progression of, people start off and typically are in the spot markets. And it's usually just like this first avenue for traders or people who are trying to make investments. And, spot to me is like, you on the spot, like whatever you're trading for, that's exactly what it's trading for at that moment. Just whoop. And then, that's a little bit of the gateway drug. And then they're thinking, oh, what else is out there? And typically people will start messing around with futures, but now we're talking about perpetuals here. So are futures and perpetuals the same, or what's the difference between the two of those?
There's actually a lot of difference, I would say. And I think there's a lot of difference from the use case to who's actually using them to even how they are built, right? Traditional futures is effectively, for lack of a better word, it's a promise to sell something, a certain quantity at some certain price at some certain time. So it's like I go to KRN and I say, hey, KRN, I'm willing to sell you 500 barrels of corn at $5 per barrel at this certain date. Now, KRN might really like that because let's say KRN is a restaurant owner. KRN, honestly, I would love to eat some of your food sometime. You seem like a great chef, right? And let's say he's a restaurant owner and he wants to make sure, he wants to forecast the profits, or he want to make sure that, the revenues that he's making is going to be more than the cost he's producing. So he wants to lock in the amount of corn he's receiving as a restaurant before some certain date, right? So he might like to buy, 500 barrels of corn at $5 per barrel on December 12th. Now let's say I am a farmer and I want to make sure that I secure my profit because I don't know if the weather might, maybe there might be some drought or there might not be enough rainfall during some season, and all of a sudden, the amount of crops I produce is a lot less or affects the quality of my crops. That way I can kind of lock in my price and guarantee a future profit, right? And I think that's one of the main utilities of a future. Perps, I think, are a bit more used for speculative purposes, though they can be used for hedging. It's just not in the traditional sense. Karan, I think you want to jump in here if you want to.
Yeah, no, I exactly. Futures, originally, like Justin just said, they started or they came about as a way for actual commodity traders to hedge their exposure, right? And so the function and the purpose that the asset or the market serves is different. So with perps, they're an extension of futures contracts, but the key difference is it's in the name, perpetuals. There's no expiry, right? And with futures contracts, the way they used to work, or the way they work, is when every futures contract kind of has an expiry date. And on the expiry date, all contracts need to be settled. So your position needs to be closed, or you need to be delivered the asset, or you need to deliver the asset, or you have to roll over your position to the next sort of cycle, right? But with perps, there's no expiry date, which is why, like Justin said, it's actually much better for speculators. And there's no actual delivery of the underlying asset or commodity required. And I think that's one big key difference. And and that this sort of allows perps to offer much higher leverage than like a normal futures contract would.
Also,
right?
yeah, if you talk to this, I think the expiry date is pretty key, because if you talk to a lot of retail traders, they have a good feeling of if it'll go up, like a crypto will go up or down, but they don't know when, right? And the idea of, like shoot, it needs to kind of go up before this certain date, that scares them a little. So I think naturally we see a lot of more like retail traders and speculators using
Absolutely.
perps.
And like I think the way the market behaves is different in both as well, right? Like similar to options with futures, as you get closer and closer to the expiry date, like the price of the futures contract like just naturally converges to the spot price, right? But with perps, because there's no expiry date, that's harder to do, and that's where kind of like funding rates come in to help you peg the price of the perpetual swap to the spot swap or the spot asset. Otherwise, you could have like futures traders just going like berserk on like 100x leverage, and Bitcoin's like 100k on futures or on perps, and it's like 50k on spot, right? So that's another like key structural difference between perps and like futures.
Would it be fair to say that one of the reasons why when a derivative like perpetual future exists is because of humans' innate desire to bet big, right? Because people love to speculate. We love to speculate on the price of an asset, right? And what perpetual futures allow is this particular action to be taken by traders using what we call a leverage, but there is no expiration date. But just to zoom into the leverage part of things, say if I have like one Bitcoin and I think that Bitcoin's price is going to go up in next few months, right? And I'm like, oh, I wish like I had 10 Bitcoins so I could earn more, I could make a lot of profits on my long trades, right? Now, I can do that by taking a leverage on my trade. What I want to understand is, so when I'm taking this leverage, where does this borrowed money comes from? Like, am I using other people's money? Am I using LP pools? Am I using market makers? Like, how does the system works behind the scenes?
It depends. And I think this is where a lot of people get confused, because there's so many perp dexes that have different ways, right? If it's a order book, typically you're not actually, essentially you don't need to borrow any money. You just need to make sure that there's a market maker that's willing to take on your other side of the trade. If it's a LP pool, you are effectively, sometimes you borrow, so technically in a over-collateralized protocol like GMX, where effectively you can't open a long position more than the TVL, you're technically borrowing. But in some cases, like a virtual automated market maker, in some case like us, you're not effectively borrowing, but you're taking the counterparty of an LP set of trades. So a great example is actually, say there's like a low volatility asset where you want to open, let's say like $100 million long on a stablecoin pair, like USDC, USDT, right? Now, historically, USDT and USDC, they don't deviate that much, right? But let's say there's only $1 million in TVL, right? Then you would think, how can I open a $100 million long on a USDC, USDT stablecoin pair when there's only 1 million in TVL? And the reason for that is because in an example like this, the LP is the counterparty to the trader's profit, right? So if the trader wins, the LP loses. But in a historically stable asset of something like USDC, USDT, where they're probably making like 0.001 bips per trade, they wouldn't, like that's not enough to drain the entire LP. So therefore a trade like that is possible to happen. But I think when you go to the more conservative or long tail side of things, where a trade can naturally like flip the exposure of the LP, that's when you start to see more protocols going towards, okay, let's make sure that there's enough LP or enough TVL or enough collateral to cover a trader's position.
I mean, I think absolutely agree. Like, and just to maybe frame it a little bit differently, like I think like the way I view it is like whether it's an LP or an order book, like in a way, the leverage is kind of still built into the product, right? Into the actual perpetual swap, right? And the real difference between these architectures is how the risk is managed, right? So the leverage, like Justin said, it actually just comes from like if you're an order book, it comes from like the other side of the order book, where you as a trader are posting margin, right, which is your collateral. So like you said, if you have like $100 in Bitcoin, that's the margin that you're posting, and you'll get matched with someone else on the other side who's taking the opposite position, which is usually probably a market maker, right? And ultimately, like an order book, the goal of the order book is sort of to facilitate or provide enough or bring enough traders together to ensure that when someone's liquidated or when basically they need to pay out profits from these trades, there's enough depth on either side to make that happen, right? And with an LP-based DEX, it's ideologically kind of the same, but Justin's right. Like in some LP-based DEXs, you have limits to how much leverage it can offer, and that's sort of constrained by the TVL, and that's to ensure like the protocol's solvent, right? And that's why I said like the key difference is like how these different like protocols or the architectures, how they manage risk. Right, like for most order books, you'll see like an insurance fund where if they're not able to like close a liquidated position at like the appropriate price, the insurance fund steps in and sort of covers that. Or if they're able to close it at a higher price than the liquidation price, the insurance fund will kind of like collect that that profit from the liquidation.
So a very good example of why this can be important is because, Braden, let's say you have $1 in the exchange and then you do a 10x long, right?
Mm-hmm.
And then Krinza theoretically can be the counterparty if she puts in $1 and does a 10x short, right? Now let's say what happens if the Oracle price of the asset, or if you're building a perp DEX where it's trading on Oracle, like let's say the asset 10x's, right? And Braden, you theoretically make, I don't know, like $100 from your trade. But
yeah,
hey, wait a minute, Krinza only put in $1, so where does your money come from? And in that case, that's when it gets tricky. Of okay, how can we ensure that there's enough liquidity for Braden here? And that's
right.
As Karan was talking, the insurance fund for most exchanges, not for us, but yeah.
Okay, and I think that's what like for me the margin and being liquidated makes a bit sense. If I think I'm understanding it correctly, it's like your margin is like the about as much as you can go down. So if I put $100 in and I 10x and the price goes down, like it's going to basically cap me at losing equal to like $100, and that way it's not like losing hundreds of thousands on the other side. So then I get liquidated, and that margin goes to, or
if it's the most capital efficient exchange in the world, they would want to liquidate you at 100. But because it's not guaranteed, essentially so let's say you were long and then Krinza was short, right? Let's say you win and then Krinza gets liquidated, you technically, like, since there's no counterparty to you, Braden, theoretically the best move, maybe not the most user-friendly move, would be to close your position too, because there's no one taking your side anymore, right?
Yep.
But inherently, what needs to happen is they say, okay, it's really bad UX to just force close Braden, so we're going to hopefully find someone to take Krinza's position. And that's the case where it becomes very tricky and very sensitive, because sometimes there might not be a counterparty for your position. And in that case, the exchange takes on the loss, which is where the insurance fund comes in.
And Braden, you're kind of right. Like in a way, like intuitively you're right. Like what you're trading against really as a perp trader is like limited by the amount of collateral that's on the opposite side of the book. The leverage it's just coming kind of from the mechanics of the contract, right? Like I don't want to say thin air. It's not really thin air, but it's not actually like there, right? It comes from how when they decide to liquidate you, to make sure that there's enough to pay off someone on the opposite side, and then hopefully, like Justin said, someone is willing to step in and match to your position again if you don't want to close your long that's currently open. And that's kind of how it works in order books, right? But with LP-based pools, you have like an instant counterparty, which is the liquidity pool. So, and that's why, like Justin rightly said, in most of these, depending on the model, like you can definitely configure these parameters, and you can maybe like play around with the risk like spectrum that you want to take on. But yeah, to be the most solvent and the most secure, you would limit it, like you would want to be like over collateralized, which means you would want less in open interest than the TVL that you have.
Yes.
Okay.
And
interesting.
They would, so if there was the most capital efficient, they would try to liquidate at 100, but because it's not, they would liquidate you slightly earlier. So when you only have $10 or $20 left in your collateral.
Okay.
And that's
So
called your maintenance margin. Sorry, but yeah, just
maintenance part. Okay, no,
yeah.
that's good to know. The more you know, the better. So then I think uh, then on the opposite side, this insurance fund is what would help on the longing. Like the shorting makes sense. There's like this cap, but like if I long, some random meme coin and it just goes on an absolute tear, like goes up 1,000% in a day. Find it hard to figure out like how is the exchange providing enough money to like keep up with that. Like if I put in $100, it goes up, let's say 10,000%, and now the exchange is going to need to try to keep up with what 100,000. I don't know, quick math.
So
Uh, yeah, how does that work on the positive side?
So I mean, like, absolutely, like the more illiquid an asset is, and the more leverage you offer on that asset, the harder it's going to be for the exchange to actually settle that position if there's a liquidation, right? But I think Justin actually like kind of like referred to the answer here, like earlier when you were speaking about, where you kind of hope that market makers step in to sort of fill in the other side of the book, right? Of course, if it's like an absolute shitcoin, it's going to be much harder to find that liquidity. But most markets that are live on like Orderbook based exchanges are being sort of catered to or like serviced by market makers. It's not just like retail versus retail. That's something to keep in mind, right? If you're trading on an Orderbook, you're very likely trading against the market maker, right? And so that means they're taking the opposite bet to you with all the information, etc., that they have. But it's just something to keep in mind. Like, so it's not always the insurance fund that steps in. Normally
Okay.
you try and close the position within the order book, and it's only when there's not enough liquidity in the order book that you would need the insurance fund to step in.
How I have created my mental model around this, like the kind of perp taxes there are, is basically three things, right? So if I'm using an order book model, I'm playing against a market maker. If I'm like using a perp tax that uses LP pools, it's basically LPs, right? But then we are also seeing this hybrid model comes in. Does that mean that there is like a balance of market makers as well as like LP pools coming in? Like how is this different than any other things?
Yeah, it's not as simple as that.
Okay.
Like, I mean, I think when you talk about hybrid, and I think this is my take on it, and I'm happy to hear like Justin's take, but I think what they're trying to solve with the hybrid problem is like, with LP pools themselves, like while it's easy to like bootstrap liquidity for a market if you have like, liquidity in the pool, the managing your risk is harder, right? When you want to sort of like provide liquidity to more and more like markets or more like riskier markets. And that's when they try and combine that with like an order book. And the idea really, like, this is what I see, like ideologically, what they're trying to do is try and get market makers involved and match orders wherever possible. But if say Krinza comes in tomorrow and wants to open like a $1,000 long on like Bonk Inu or something, and there's no market maker willing to take that trade, they may have a liquidity pool that's willing to step in until they find someone who's taking the opposite trade to Krinza, and then you'll be matched against the order book. I think that's mostly kind of what the hybrid designs look like. I think another way that you could consider like hybrid is like the way Hyperliquid's doing it. In a way, it's a little bit hybrid, which is they have a club, right? It's on chain, but they have the HLP vault, right? Which is basically a market making vault. So what Hyperliquid did really well is they were like, I think similar to the Vest team, they were market makers before, and so what they decided to do was build this exchange and use the HLP vault to market make all of the markets there, and they sort of open source that to retail to make deposits in that vault, and so in a way it's kind of like a vault is providing liquidity to their order book, but it's still an order book. But I guess that's another way you could say it's a hybrid, but really it's an order book.
I wouldn't say Hyperliquid's hybrid. It's still purely order
No,
book.
of course, I know.
Yeah.
I'm just saying it's just another way to like maybe think about like how the hybrid exchange like kind of like looks like, right? Like in a way they're using like vaults to source open source liquidity, which is what we're doing with LPs, but it's an order book. But, yeah,
Well, the way how I would just very simply explain it is, okay, who's taking on the risk here, right? It's either LPs or it's a market maker. And it's just we can give you a better price. Like if a market maker comes, theoretically, if it's a correct hybrid model, it should be if a market maker is willing to give you a better price, and in that case, therefore take on slightly more risk, then great, we'll route the order to them. But if the LP is willing to take on a higher price, great, we'll route it to them. That's kind of the difference, yeah, I would say.
So then, we're talking about we just talked about the liquidity providers and the market makers in the hybrid. But even in the individual models, like how do perps benefit liquidity providers and market makers, either in the separate systems or in a hybrid? And how are these stakeholders profiting off of these perp systems? Karan, you want to start us off?
Yeah, happy to. I mean, like with LPs, it's like quite straightforward, right? Like you're the counterparty. As an LP, what you're really just making like a bet that on a long enough time horizon, traders are losing money, and so you will make money, right? Like your yield as an LP comes from the fees that you earn, and then like the losses, the trader losses and liquidations that are socialized, right? And of course, like when there's liquidity bootstrapping, you get like token rewards or liquidity mining incentives, etc. But at its core, like this is how it works. Like the yield comes from the fees, and LPs are basically saying, hey, look, on average, traders will be wrong. They will lose money, and that's where you see a lot of perps like get like 30% APRs, 40% APRs, even higher during times of like volatility. Like historically, it's true. Like most traders do lose money, right? And I think that's like the big benefit for LPs, right? Like if you're holding ETH or stables and you want to earn like some yield on it, being an LP to perps is a great way to get like a lot of yield, but of course with like added risk. Like definitely want to put that in there. It's not risk free like Aave or like even Aave has its risks, but it's like relatively like risk free. But the yield's much lower, right? So with LPs for perps, you get much higher yields than you would like in other sort of DeFi applications, and that's because like traders are willing to pay a premium for the volatility, for the leverage, etc.
Yeah, to try to answer as simply as like the original question was, how does perps help LP? I think fundamentally and maybe more practically is that perps attract more retail traders that think they're going to make $1 million with $100, or they're going to make it. And there's a lot of noise, effectively, that happens. Practically what happens to LPs is they end up making a lot of money because traders generally just, as Karan said, like they lose, right? So the idea of leverage attracts really like retail traders into thinking that they can win. How it affects, how it helps market makers is very similar in the way that all of a sudden people are putting orders, or in general, let's just assume the average retail trader is putting market orders rather than limit orders. They're putting orders that take up more orders on the book, right? So for example, if I have $10 in an order book model, I could only take in $10 worth of a market maker's order. But if I put in $10 and I do 10x leverage, all of a sudden I can do $100 worth of orders on the book. Now, this goes a bit more into the secret world of market making, which is black hat market making, where sometimes because of this, a market maker will put spoof orders and say, like, oh, you want to trade $100? Okay, like we'll give you $10 at 5 cents, we'll give you another $10 at like 6 cents, or another $10 at like 7 cents, right? And then the moment the retail trader puts that in, they will immediately eliminate half of those orders and have them execute at like, I don't know, like a much higher price, right? So for market makers, it helps them because effectively they take up more orders on the book. And for LPs, I think it helps them more because it attracts more noise traders. But I would argue that right now it doesn't really help LPs fundamentally, maybe more behaviorally in the way that it attracts the noise traders. The reason why I don't think it helps them fundamentally is because there is a mispricing problem. So I don't believe the model of GMX or the model of like maybe gains trade works, where effectively you're saying, hey, on average traders lose, therefore, you know what, don't worry about the risk, man. Just here's this nice vault, here's this nice casino you can deposit. On average, statistically the traders participating in this casino lose, and therefore you're probably fine, right? This is a very bad idea when it comes to people who have insider knowledge or more sophisticated knowledge. And this is exactly the reason why many protocols have blown up. Partly because traders, from time and time again, it shows that either a trader wins like everything, either there's some bug in the code, or either something happens where some bad founder just crashes the entire FTT, like, or some price of a stock.
I mean, yeah, I think I remember gains during the Luna crash, right? They blew up. I remember that.
I don't want to name drop, but there was many many other exchanges, and it's crazy because you see some of them still alive today, and it's really crazy. Yeah.
No, but I think I agree, right? Like I think we have like the benefit of kind of being able to study like some of the mistakes that protocols before us have made, and I think even with LP-based DEXs, like they're kind of evolving slowly. Like even at RFX, like some of the things that we're trying to do where like the fees are like liquidity sensitive and like they respond to like market conditions and like, you know, I think if you look at like GMX V1 or gains, like things like protocols that Justin mentioned, they didn't have like slippage or funding rates and things like that, and even they slowly over time introduced it because they realized like you can't have like there's no free lunch really, like you have to sort of mitigate the risk, and you kind of need to have the systems in place to be able to weather any sort of like market conditions or volatility, right? And so I think it just goes back to like the start of the podcast, like where we kind of discussed briefly like liquidations and risk, right? It just goes down to how well your exchange is able to manage risk, and it's more than just liquidations, right? It's like the caps for each market, like the OI that you can handle, the leverage that you allow, the fees that you charge, and it can't be static numbers. It can't be like, hey, every trade will charge you like $1, right? It has to respond to, like if everyone's going 90% long in one market, you will want to charge them more because you're adding more risk to the system if the market's entirely in one direction and they're right? Like, so things like that, I guess, matter. And I think when it comes to like market makers, I think that was the second part of the question, right? Like how perps benefit like market makers. Like I think like, yeah, Justin rightly said, it's like they're able to sort of trade against retail. So I mean, and I think like fundamentally, like the money they make comes from like the spread, right? Which is from like the bids and the asks and the order book, and that's how they kind of like profit, where like they're basically providing continuous liquidity all across the order book, and they set like multiple bids and fill like multiple asks, and like the net difference between all of those transactions is basically where their yield comes from. But I think another like important function for market makers, and this is like across both like order books and LP based DEXs, like we're working with a few market makers to like do this, is like funding rate arbitrage, right? Which is like if a particular market on a particular exchange is paying really high funding for taking a position on, a market maker can normally, you know, step in and benefit from that. And like on some occasions you see funding APRs go up to like 15, 20, 30%, depending on you know, how volatile the market is, and that's a lot of yield like right there, right? So I think that's another like way that Perps kind of like found their product market fit, more than just like speculation. It was like arbitrage and hedging, like, so yeah.
Yeah, I mean, let's dive deeper into the risk part of things, because sure, like perps can amplify the gains, but it can also turn up the risk meters, right? So if you have to give any new user who's like trying to explore the space and like trying to trade some stuff and like make some money, what are some of the risks associated with the system that every user should be aware of?
Yeah, I think the first and most common is just your inventory risk or your liquidation risk. Crypto already is a very volatile industry, right? And to add leverage on top of that is, for lack of a better word, very, very risky. So that's number one. I think the other one, which is hasn't really been talked about publicly, but I think has been a large topic in this conversation, has been the insolvency risk of the exchange. Exactly, okay, how is the exchange that I'm trading on going to guarantee the liquidity of my trade? Is it a market maker? I wish exchanges would be public. One thing I wish would be really cool is if they could make public on the market maker, or put public information on the market maker, like generally like what is like they can't reveal anything, right? But historically, they can know like, okay, like what is like is this a market maker that typically comes in and is high risk profile, and if there's like a big volatility on the asset, are they going to be there to guarantee the liquidity of my trade, or you know, am I trading on something like I don't know, like a virtual automated market maker, something back in 2022, where the liquidity of my trade is not guaranteed, and yeah, I would say that's probably more of the untalked about risks here, but. While I'd love to see like traders more aware of that, it is understandably very hard to, because you have to effectively know very well how does an exchange work, how does it guarantee your liquidity, and etc.
Yeah, I mean, I think that's like one kind of like counterparty risk, right? And then like you have like the other kind of like counterparty risk, which you like. I think this has been like discussed at length, and which is like kind of like the FTX type of counterparty risk, where if you're trading on a CEX or you know a centralized venue, then you don't really hold custody of your funds, and like you're not sure whether tomorrow your funds are going to be there or not, right? And that's the kind of risk that you will never experience on a DeFi protocol, because you know you always retain full.
An ideal DeFi protocol, I would say.
Of course,
but
yeah.
not.
Yeah. Like principally, like you wouldn't, right?
Yeah.
But Justin makes an important point. Like I think like solvency risk is like super important, right? And I think like we touched upon it like quite a bit over the last few minutes, like over this call. But there's different ways to manage your risk, and that's the key part. Like how is a protocol ensuring there's always enough liquidity in the exchange to pay out profitable traders, right? Yeah.
So a very good example of, I think, the dangers of over-relying on a market maker is back in 2024, and this isn't a way to call out an exchange, but more so to bring upon education upon the system, right? Back in 2024, there's a very famous order book DEX. Typically relies on market makers. There's a Pepe crash, and because of the Pepe crash, a lot of market makers were very scared to put orders on the book. So they withdrew all of their orders, and you know, normally, like if I were to visualize this, I don't remember the exact price, but if I were to visualize this, the candle would look like this after the crash, right? But because on this exchange, market makers withdrew everything, the price on that exchange went down to this. Like you can't even see on my camera. That's how bad it went. And that's fundamentally because of the reliance on market makers needing to come in and step in and quote orders on the book. Mm-hmm. This is a very, very big exchange, and I would say probably the most popular exchange right now.
I guess my biggest takeaway from this podcast is basically me knowing that all these market makers and LP providers are my enemies. As a user, as a trader, like I was LPs are cool, like market makers are cool, but now I know like who would be happy like if I'm losing shit at this.
So I'm gonna get so much shit for saying this. I fundamentally think there's a internal, maybe not like a 90-10, but like an 80-10 conflict of interest between market makers and traders, because a market maker's the way how they make money is by quoting the widest bid-ask spread. They're not there to quote the best price for you. They don't. Yep. I was gonna, for lack of a better word, they don't care, right? They really don't care. They just care, like, okay, like how can I manage my risk? And therefore, the best way to manage my risk is by quoting the highest bid-ask spread. And the only reason why they do it tighter is because there's other market makers that they're competing against, and you kind of have this game of perfect competition, and everyone's kind of doing tighter and tighter and tighter. But they fundamentally do not care. Yeah,
you gotta remember it's zero sum, right? All these markets, if you're a trader, it's zero sum. If you're winning, someone else is losing, and if you're losing, someone else on the other side is winning.
It's zero sum, but it doesn't like so. This is something that we fundamentally believe at Vest. This is something that we are fundamentally trying, is that we're saying, okay, what if we could create a way where we can guarantee a fair price that is slightly in favor of the LPs, but is not there to maximize profitability, right? And that's essentially what we are doing. And I think what you get is something that's very great trade execution, something that's fair, and eventually we'll be able to prove this with ZK proofs. But that's another conversation that we'll put out a month down the line.
Because it got brought up, and I think that's obviously a lot of what people think about when they think about like risk. But after everything with FTX, the silver lining was like the adoption of DeFi, seeing like, oh shit, like it does matter, like centralized versus decentralized, and people understanding the importance of non-custodial, transparent. But DEXs are typically not as user friendly. As a typical experience of the centralized exchange. So, what's the current state of adoption like for RFX Invest's approach to building a platform that gives users like an intuitive, like centralized exchange experience? And for instance, if you have to go sooner than later, then we'll have you start just in case you have to leave, and Justin
Yeah,
can drop in
absolutely.
after.
Yeah, I mean, I think like DeFi usage in general is still trending up, right? Like, and I think generally as an industry, there's better infrastructure now than there was like say like 2 years ago. Like account abstraction, session keys, things like that. Like there's a few. Like let's say like UX improvements or leaps that we're making. But I think there's still some work to do to make it feel like you're on a CEX, right? And which is what our goal is, right? Like when you trade on RFX, we want you to feel like you're trading on a CEX. And like I think as we progress, we'll make sort of more and more improvements to the app to make that happen. But some of the things that we're doing now, which is like one-click trading, gasless transactions, like I think that's a key, right? Like the biggest pain point for users, I think, is like having to have gas in your wallet, sign a transaction every time you want to open a trade. Like we want to solve those first, and then we can add in more things like, hey, can we get them to do like more advanced orders? Like can they execute things like trailing stops? Can they execute things like twaps? And like these are things that are available on CEXs, right? Because doing it on chain is harder, right? It's not easy, and like we want to be able to do it in a way where we still kind of like preserve those principles of like decentralization and trustlessness, but still try and like offer that same kind of like experience. And it's gonna be like a step-by-step thing. And like I said, I think we have some of the tools now to make this happen. And like being on ZK Sync is like great because you can have account abstraction like out of the box. So we have like gasless trading from like day one, right? So things like that I think are the key. And then like I said, slowly we'd probably see more DEXs focus on like how can we add more of like the utility and tools for traders that you see on CEXs on a DEX.
I think, in my humble opinion, in terms of user experience, I do think we are there in many other ways. The part where we aren't there is the onboarding. Most people, like, this is a very common knowledge. Like, most people, like, they don't really know what a wallet is. They don't know how to onboard fiat into crypto. They don't know any of this stuff. And I think that's where the biggest barrier to entry, at least anecdotally for me, has been. Whenever I talk to a user that comes from a SEX, they've heard of decentralized exchanges, but the reason why they don't go on it is because the onboarding cost is high and the trust is not there, which is very, very ironic if you really think about it, because that's the whole point of DeFi, is to eliminate the need for trust. I would argue that one place where DeFi does great user experience that's differently than SEX is it creates a way for innovation to happen. Us as an industry and human race, we cannot move forward if no one really comes in and take these risks. And because we have great builders like RFX and I like to say Vest, you create new primitives where, for example, like on a AMM based exchange, you don't need to look at the order book and like all of these like you're not seeing you're trying to open a market order on a trade, like let's say on like WIF, and you're not seeing the slippage on the trade increase from like 0.1 in 1 second and then 1% in the next second, because that's how fast the order book moves, right? And I think subtle utilities like this, where on an AMM pricing is generally more predictable, these things help in the long run. So yeah, to answer your question, I would say the onboarding cost is really the difference here, but the way how I think DeFi is going to win is through these novel innovations and through these, completely new ways to trade. I haven't seen. There probably are some centralized exchanges that do things like pair trading, but I haven't seen them, and I definitely haven't seen a centralized exchange do something like a HLP vault or like a GMX style vault where all of a sudden you can democratize market making to retail investors. Yeah. So yeah, I do think we're there. It's just the onboarding part. Like we have gasless transactions, we have like account abstraction on, on ZK Sync. We have all these things. It's just the onboarding, which is tough.
Yeah, I think the on ramp, off ramp, it's definitely easier once we have like more, let's say, like regulatory clarity, right? Like just as a DeFi derivatives protocol, it's maybe that's like a cop out, and I think like maybe the other way that I see it is like the core set of users that use these kind of protocols are guys that are already kind of familiar with on-chain trading, and like that have maybe use Uniswap a lot, right? And like there's maybe less of a need of like on ramps to and off ramps to fiat right now. But I definitely agree. Like if we ever want to be like the Robin Hood of like blockchain, or like Top or something like that, you need to have like the onboarding flow, which we don't have right now. I definitely agree.
Yeah.
It's cool to see the like account abstraction stuff be actually put to use to make that better, and I like that.
Oh yeah.
It's just like now it's like, yeah, we of course we got that, and you're always talking about that innovation, looking for what's the next thing to make it even better. So that's very cool for both, and I can't wait to check out both of you guys, both the protocols, and try them out as an LP provider. Maybe a little trader, but
hey, if you're an LP, now's the best time to get into RFX, right? We have the LGE, we have some incentives.
Oh wait, Brayden, you're based in the U.S. No, you can't. We didn't hear that, man. Wait. What do you? No.
Fly to Puerto Rico before you deposit.
That's right. Yes. Okay. Never mind. I'll be watching. How that works.
Yeah, you could watch from the sidelines.